Okay, welcome guys to episode number 51 of the FTSE show with myself, Chris Chillingworth. It has been a heck of a long time since I've done one of these. I think 2 years now, probably about 2 years. Almost to the month, I think it was April 2019 or 2020? 2020 probably. April 2020 that I stopped doing this. I'm thinking. I might be wrong with that, but it feels like 2 years anyway. What's been happening with me very briefly over the last 2 years, quite a bit. I've moved house. Loads of things have been going on in my life which have prevented me from being able to do any of the FTSE show episodes anymore. My life has changed quite dramatically in terms of what's going on a daily basis. Get my words out. And so here I am now in May 2022, and I have got Mondays available to start recording FTSE show episodes again, which means they're probably going to be coming out every Tuesday, one a week at the moment. That's the best I can do, but it's been something that I've been really keen on getting back involved in. I've had so many emails and messages from people asking me when the next FTSE show is going to come back and all this kind of stuff, even from friends and family stuff saying, people telling me I should get back into doing it. And so here I am, and we're going to dive straight in. I don't have the backdrop of the library anymore. And I don't have any of those books anymore. I'm not going to go into detail about what's happened, but I have moved house and I don't have any of that anymore. So I'm looking into getting my face back on the show just to introduce these shows again, but I need to make some arrangements and to find the right setting. I don't want it to just be me in my bedroom sort of thing. So I want to make it look good and look cool. But we've got some new slides, and I've changed the way that we're going to present this data. I want to make it more YouTube friendly. Obviously, a lot of people are watching on the mobile phones these days. So being able to, if you remember the old spreadsheets, they were very difficult to read. You couldn't quite zoom in very well. So I've made some changes, and I'm hoping aesthetically at least it's going to look better. I'm also hoping to reduce the time of the videos to more sort of 15-minute episodes if I can. Obviously this one's going to be a little bit longer because I've had to kind of introduce and say hi again after 2 years of not speaking to you guys, but hopefully you'll like the changes. And I think, again, like the first season did, the FTSE show is going to evolve over time, and I'm going to throw more money into it, and so we can increase the budget and increase the production of the whole thing. So let's get started. Today, we're going to get started with Season 2, looking at McColls. Now, I don't know if you've heard the news, but McColls, literally end of last week, announced they were going into administration. And that was not a surprise to me. This is a company I've been watching for quite some time. Probably since 2018, I've been aware of McColls in terms of when I first started my analysis of this company. And I knew straight away it was a company I would never invest in. And we're going to take a look into why that is, because as you'll know from if you've ever seen this show before, you'll know that we look at companies that aren't ripe for investment as well as companies that are. And I think that that helps well in identifying what investors should be looking for in companies. So McColls are known as McColls Retail Group. They're a British convenience store and newsagents operator. They also operate post offices in about a third of their estate, making them the largest post office operator in the United Kingdom. They've got 755 shops or stores branded McColls. There's 270 branded Morrisons daily. That is because they made a partnership or a deal with Morrisons to basically rebrand that, and that is actually coming into play now because as of today, Morrisons have put in a bid to rescue McColls, so they'll probably become part of the Morrisons brand. Morrisons are looking at taking on all their debt. They put in a bid initially, and that bid got rejected because the debtors, the people that McColls owe their debts to, wanted the money paid up front. And the original bid from Morrisons was that we're going to take over McColls and we'll pay off that debt slowly. And the debtors said, no, that's not not acceptable. We need that debt paid immediately. Morrison's went away and they've come back today saying that they've changed the bid and they're actually willing to pay off the debt. And we're talking about it's something like 200 million. We'll take a look at that in a moment. 200 million's worth of debt that Morrison's are going to eat up and just pay essentially as part of this deal. They obviously see long-term opportunity to use the McColls estate probably to expand the Morrison's Daily brand, which may well work out. But as McColls as an investment, they've not done very well, and obviously they've moved into administration. So anybody owning shares in this company are licking their wounds right now as the share price has fallen all the way to 1 pence. There's 116 stores branded Martins, just Martins, and 8 branded RS McCall. So I'm going to start off with vertical analysis. Let's get going. So as you can see along here, we've got the years. We haven't got 2021's data because their 2021 annual report is not out yet. And it probably won't be now if they're going into administration. That probably just won't come out. Revenue, as we can see here on the top line here, this is a vertical analysis, so we're looking at each column, we're looking at year by year essentially, and revenue has been growing. So this is a company that obviously haven't had a problem with finding growth in terms of sales. That's one thing, and this is why as an investor we never just look at revenue, because on face value this revenue looks good, it's growing, it's going up, right? And so a lazy investor, if you will, might look at that and go, well, McColls are doing great, they're growing. But then we look at the cost of sales, the cost of essentially the revenue coming in. Cost of sales is different to expenses. Expenses will be things like staff costs, rents, stuff like that. So the day-to-day running costs, whereas the cost of sales will be things like buying the products that they sell. It basically gives you your gross profit. So it's the revenue minus the cost of sales gives you your gross profit. And then what I like to do, instead of just looking at the gross profit financials, I like to look at it as a percentage of the revenue. So what's left over as a percentage of the revenue that's come in. And as we can see here, we're looking at the gross profit down here. It's about 25%. So we're looking at nearly 10 years worth of data. This is almost a decade's worth of data here. We're looking at 9 years. And the gross profit has consistently, over that decade, been stuck at about 24 to 26%. Now, that's not terrible. It's not great, but it's not terrible. There's opportunity to do okay if your expenses aren't too high. Here is McCall's major problem. The expenses are too high. And what we do here is we look at the expenses as a percentage of the gross profit. So no longer a percentage of the revenue. We're looking at the expenses, so the staff costs, the rent costs, all the everyday costs of running that business, as a percentage of the profit that was left over as gross profit. And as you can see here, looking at the expense percentage, it's pretty much 100%. Every single year, apart from a couple, the expenses have cost the same amount, if not more, than the profit that they were holding, which makes them unprofitable, right? The expenses are too much. I mean, we look here at, let's take 2013 as an example. So revenue came in, 869 million's worth of revenue came into the business. The costs of sales, the cost of selling the stuff, came to 658.4 million. That left them a gross profit of 210 million, let's call it 211 million. Okay, 24.3% of the revenue. But their expenses, the cost of running the business, cost 212.9 million, which meant they finished with an operating profit of minus 1.9 million. And we look at this bottom line here, the operating profit, which isn't the actual profit. We're going to come to that in a moment. This is just the operating profit. This is before taxes and before other costs as well. So it's going to get worse. But if you can see here, 2013 they made a loss. 2014 they lost 10.4 million. 2016 they made a loss. 2017, their best year, pretty much. And this was largely because their expenses were only 94% of the profit, so they were actually able to keep some of that money. 16.7 million. But look here, 2019, boom. Revenue came in, 1.2 billion. Cost of sales, 0.9 billion. That gave them a gross profit of 315 million. You'd think, okay, maybe this is going to be a good year for them. Then the expenses came in and just destroyed them. 128.7% of the profit gone on expenses. Well, you made a loss of 90.7 million. So all of those good years you've had before completely wiped out by 2019, just killed them. So let's go deeper underground, as Jamiroquai would say. So operating profit is now the top line. We're going further down. We've got finance expenses, so the costs of things like interest on debt. What is the interest on debt? Now these are costs. Okay, so this is not money coming in, this is money going out. Then under that we've got the sale of assets. That's money coming in unless it's got a minus figure. So in 2019, so most of these is money coming in from the sale of assets. They might sell some of their stores and reduce the number of stores, for example. Well, this is money coming in from the sale of those assets. It could be that they sold some stocks that they owned in other companies, perhaps, that sort of thing. Sold off some investments of some kind. Any assets that they own that they've sold off, that's the income. Sometimes that costs them money, sometimes it's money coming in. And other income is really obscure. I mean, most of these annual reports and the financials don't really dig deep into what that other income is, but it's got nothing to do with the everyday recurring business. And so what I do as an investor is I omit those. I omit them. I take them away. So the sale of assets and the other income, I deduct them because they've got nothing to do with the everyday recurring business. Okay, that's nothing to do with what they're selling in their stores. That's just they found another way to make a bit of money. Now, that's important to do because by the time we get to the bottom and we actually look at the profits, we can actually identify what the true profits are of the operating business, the actual everyday recurring business, what McColls are all about. Okay, we don't want to be coloured or influenced by the sale of a chunk of the business, right? Because they'll report that as profit because they have to. That's typical accounting rules, right? So it will be reported as a profit, but it's not really a profit because they can't do that every year. They can't sell off a chunk of their business every year. It's not sustainable. So we're not interested in that income. We're not interested in that cost. We omit that, whether it's a profit or a loss. We take it out and we look at just what the company are making from their everyday business. So sale of assets, other income, it's in here. I've put it on the slide, but we're going to take those away and we're not going to include them. Then we've got taxes. There's not much they can do about taxes. They have to pay what they have to pay. And then this is the reported profits. Okay, so this is what they've been reporting as profits as a company. This is where investors become unstuck because, as you can see, from 2012, 2.5 million profit. 2013, 5.1 million profit. 2014, 9.9 million profit. And an investor looking at the reported profits, these are the reported profits in McColls' annual reports, in their financials, in their financial releases. For 2016, they reported in their annual report, they made a profit of 13.9 million. Now, investors interested in McColls will be thinking, that's fantastic. Great. This is a great company to invest in. But once you omit the other income of 23.1 million and the sale of their assets, which came to £352,000, their recurring business, their everyday business, made a loss of minus 9.5 million. Now, that's the figure I'm interested in. I'm not interested in what they've reported as profit. I've looked deeper into the other income and where all the income has come from. And I'm only interested in what is the actual business itself making. And as you can see, other than 2017, this is the business that's been hemorrhaging money. They've not been making a profit. The only way they've been making a profit is by selling off bits of their business here and there and disguising its profit. Now, they might have been doing that intentionally, or that might just be part of what they've been doing. They just, as they've evolved, they've been selling off bits of the business and it's come through and it looks like profit, but it's not. Technically, it is from an accounting point of view that they are going to make money from that, and that money's going to go in their pocket. But what has the business been doing? Well, the business has been running at a loss, and in 2019, it crippled them big time. They made a loss of 96.2 million that year. And the bottom line here is the profit percentage. As you can see here, those profits have not been good. This is a percentage of what profit have they been making as a percentage of the revenue. So of all the money that came in 2017, their best year, they kept 0.5% of all the money that came in. All the other years, they lost money. They didn't make any money. So this is not good, okay? This is a problem, because what we've got here is a company that have stayed afloat by selling off chunks of the business, not from the actual business that they do, the convenience stores, right? The convenience stores are hemorrhaging money every single year and have been for a decade. Now, this is the next level, the debt analysis. So again, we've got the true profits at the top here. So we've taken the bottom line from the last slide and we're putting them to the top now. So we can just use that as a reference. These are the profits that they made, the true profits from the convenience stores that they've been making. And then we look at short-term borrowings. This is money that they've borrowed and now owe as a debt that needs to be paid within the next 1 year. Okay. And then the line underneath that is long-term borrowings. This is long-term debt that has been accumulating or rolling over that doesn't have to be paid within a year. So it might be payable within the next 2 or 3 years or 10 years or 20 years, whatever the deal is with their lender. And what it does is it gives us an idea about how much debt this company are carrying. Now, short-term debt has definitely been growing. It's grown from 2016, they had no short-term debt, to now 32.3 million in 2020 because of the pandemic. But look at the long-term debt as well. That's been growing considerably, now at 272 million in 2020. A company that have 272 million long-term debt and 32 million short-term debt better be making a profit, because if they're not, how are they going to be paying off that debt? And remember, look at the true profits. This is a company that aren't making a profit. They're making a loss every single year, and yet debts are rising. How are they going to pay off those debts? As an investor, I look at this and I just think, no, I don't want anything to do with this company whatsoever. I would never invest in this, because there are red flags everywhere. You would never invest in a company that are making a loss every single year and the debts are rising and rising. They've got no way to pay that off. They can't possibly do it, and it gets worse. But we'll come to that in a moment. Look at the earnings to debt ratio. So what this is how much are they making in terms of earnings, in terms of profits, in other words, as a ratio against the level of debt. Now, what we want to see here is something like 4 or 5, a score of 4 or 5 positive. What that basically means is you can translate this into how many years of earnings would it take to pay off the debt. So look at 2017, you got this debt here, 154.7 million in terms of long-term debt, and the earnings are that year about 6 million. That means it would take them 26 years of earning that amount to be able to pay off that debt. That's not good. So even though 2017 was their best year, the level of debt they had outstanding was way too high relative to what they were making in terms of earnings. So that's a red flag. But I'll tell you what's more of a red flag: when they're making a loss and there's an impossible to pay off that debt, and now you start getting negative earnings to debt ratio figures. Well, anything with a negative earnings to debt ratio figure is terrible, and you don't want to go anywhere near it, because it means they're not making enough money to pay the debt, basically. So what we would be looking for is a score of about 4 or 5, ideally, because that would mean that it would only take them about 4 or 5 years worth of profits that they're making to be able to pay off all their debt. And that's a healthy level of debt relative to what they're earning. So when it says, when anyone says, they've got 100 million of debt, it doesn't mean anything, because what's important to an investor and to us is what is the level of debt they have relative to their earnings power. Because 100 million of debt to BP is nothing compared to McColls. It's everything, right? And so we have to look at what is the debt level relative to the company's earnings power. Well, McColls have no earnings power, so they're hemorrhaging money, they're losing money, so they've got no way of paying off this debt. That's a major red flag. And then the next level we look at is equity analysis. So what we're doing here is we're looking at their assets minus their liabilities. So assets could be property, equipment, real estate if you're American, It could be intangible assets such as rights and licenses and stuff like that, and there's a value against these things. And so we clock up all of the assets that the company owns. Okay, it could be cash in the bank, for example. That's an asset. Inventory, stuff like that. That's all got a value to it that's logged, and they can put a value against that. So all the assets minus the liabilities, that's everything they owe. So that will be mortgages, if there's any mortgages outstanding. That will be debts that they owe. That will be money that's owed to suppliers, that sort of thing. So assets minus the liabilities then give you your net worth of the company. Okay, because if you've got all your assets and you minus and take away all the cost of the liabilities, what's left is your net worth. And you could do this for yourself personally, and we can do this for companies. And as you can see, net worth has been doing pretty well from 2012 to sort of 2017, 2018. This is a company that's been growing, if you will. And they've been doing well. So essentially assets have been growing, liabilities have been growing, but assets were growing quicker than liabilities. But over 2016 to 2018, they kind of hit this peak where they didn't really grow anywhere. They weren't really going anywhere. And it seemed to be a turning point, because then from 2019 and 2020, that net worth just plummeted. So you can see assets grew, but liabilities grew way quicker. And that's a bad sign, because what that means is that by 2020, they had a net worth about 20 million, which was half of what they were worth back in 2012. So this is a company that's gone backwards really quickly, and the warning signs were there from 2019, and I suspect this is largely caused by the pandemic. It seems likely that the pandemic has caused them this kind of problem, but obviously it was the increased amount of debts and the fact that they weren't making any profits for 10 years that is the real problem here. The real underlying problem is that this was not a profitable company and hasn't been for a decade, and the amount of liabilities is still growing. It's still going it's growing faster than the revenue and the profits. So it's all well and good getting revenue coming in, but when you're not making a profit, you've got a real problem, because you can't pay off those liabilities, and the liabilities are going to grow and grow and grow, and the net worth is going to fall and fall and fall. And now, this was 2020, they were worth 19.9 million. I suspect now they're worth nothing. And the retained earnings at the bottom is essentially what amount of capital are they keeping to grow. So this is money that's profit left over, that hasn't been spent on dividends, hasn't been invested into the business in other ways for growth and things like that. What's that pot of money, essentially? What's that value that's sitting there? And as you can see, from 2016 onwards, they started to really get into trouble here, and anything with a negative earnings, I'm not interested in. I would still stay well away from. I'm not interested in it whatsoever, because a company that doesn't make enough profit to be able to reinvest into that business and allow it to grow isn't going to grow in share price. Why would it? That share price is not going to go up because the company isn't growing, it's shrinking. So why would the share price rise? It wouldn't. Okay, so we're going to take a look at the share price here. So as you can see, McColls floated back in 2014, kind of midway through 2014, floated at a price of about £1.80 per share. So from 2014 to 2017, McColls were reporting profits every single year, but obviously underneath what they weren't sharing, and companies generally don't, they weren't sharing the fact that they were actually making, or the business itself, the underlying business was making losses every year, like to the tune of tens of millions of pounds. And then 2017 came along and they made a genuine profit. So they reported profits of 14 million, but they actually made about 6 million after we deduct the additional income that they received that we don't want to include. So that's a year that they actually did well, and you see the share price goes up relative in 2017, because investors are looking at that and they're thinking, okay, this is a company that's making profit every single year, but in 2017 that profit really started to ramp up, so maybe this is a company we want to be buying more of, so great. But they're not looking at the underlying figures that from 2012 to 2016 these guys have actually been making a loss in the actually everyday recurring business. Then 2018 comes along, they report a profit of 6.8 million, but actually they lost 6.5 million with the underlying recurring business. And then 2019 they lost 96 million, and 2020 they've lost 5 million, and it's just been going down and down and down. And you can see from the the share price, we've gone all the way down now to 1 pence a share. Now, that's so obviously I'm not celebrating this in any way. I feel devastated for anybody who owns shares in this company that's seen their shares fall all the way from, say, highs of £2.80 and they've gone all the way down to 1 pence a share. But my point is, the signs were there the whole time, and they always are. Every company that we look at where they're suffering or they've gone into administration or they're failing, you look at the numbers and you can see exactly why, and you can see years ago that the signs were all there. And this is why I've been telling my members and part of the Sussex Investment Club not to go anywhere near this company. We scored them really low. They were a minus score because of this, because of the numbers. The numbers just didn't stack up. This was a company that was hemorrhaging money every year. Now, yeah, on paper, they were making money, but they were doing so by selling off big chunks of the business or selling off assets. And that's not a way to run a business. And it's certainly not sustainable, because eventually you're going to run out of assets to sell to make a profit. Okay, your underlying business, what you do, has to be profitable, and it hasn't been for a decade. And we're seeing the results of that, which is essentially a share price eventually falling to zero because everybody cottons on eventually. And it can take some years before investors really start to see what's going on, but if you look underneath the hood, you'll see for yourself what's really going on. And that's why it's so important for an investor to dig deep into every company they invest in and dig and look at where the money's coming from, and is it coming from the actual business or is it coming from somewhere else, and what's the true picture of what's really happening at this business. That's crucial. If you're going to go and invest in a chip shop in the high street, you want to know this stuff, right? You want to know what's going on behind the scenes before you're going to invest, and the same should be for any stocks you decide to invest in. So normally I do some analysis on the pricing to work out what's a cheap price, what's a fair price, what would be a stretch price, and what price do I consider to be overpriced. But obviously in this situation, there is no such thing as a cheap price. I mean, it's trading at 1 pence per share, and that's a bad price to be buying at now, because this is a company that aren't making any profit whatsoever. And so why would we invest in a company making losses? We wouldn't want to do that. There's no return there at all. And so the only people buying McColls at 1 pence a share will be gamblers that are hoping to get a quick and cheap and easy profit. And, that's one technique that some people use. But I would say that if you employ that tactic, you're likely to get 9 out of every 10 wrong, and you'll end up losing more money than you make. So, but it's one way of doing things, just not my way of doing things. Okay, and I just want to wrap up this episode by very briefly talking about the Sussex Investment Club, which is a club that I've set up, which essentially shares the analysis that I do. So if you don't want to spend, I look at 10 years of every company from the FTSE. So we're looking at 1,000 companies, 10 years worth of financial data per company. You're looking at 10,000 years of financial analysis to do to get the information that you can get from joining the membership. And you don't have to do any analysis yourself. I can do it all for you and send out all the analysis that I'm doing to you. As part of that membership, you'll get the weekly report that I send out, which covers all of the 54 stocks that I've identified from the 1,000 FTSE stocks that I've analysed. So there's only 54 that I've found that tick the boxes. Of those 54, only about 12 of them are priced today at a price that I would consider buying at. And so I provide full price and analysis on all of those 54 stocks. Again, that comes out every week, comes out every Saturday morning. So you know precisely not only what stocks to buy, but what price to buy them at. So you know the what and the when. I also do deep dive reports on every single one of the 54 stocks. That's a 3 to 4 page PDF, which goes into detail on each company, but it's only about 3 or 4 pages long. So what I do is I kind of digest it to the point where it's easily consumable, but it has all the key information that you would need as an investor to know why you want to invest in that company, because that's crucial. It's all well and good being told what stocks are good and what prices are good, but why are you investing in that company? That's something you need to know. And over the last 9 years, that combination of stocks has achieved a 17% annual average return over the last 9 years. Now compare that against the FTSE that's been pretty much flat over the last 9 years and has achieved no return. 17% per year is pretty damn good. And that's as of now. That's as of May 2021. We're at about 17%. We were up as high as 20%, but we've taken a bit of a knock this year, as pretty much the whole market has. You get access to the members chat room, so you get to meet all the other members as part of the Sussex Investment Club. You can talk to them about the watch list and the different stocks that are on that watch list. There's no holds barred. You can talk about anything you want. Most members spend their time in there chatting about any news that comes out on those particular stocks and share that information with each other. They also talk about what stocks you're going to buy this week or this month and why and stuff like that. So essentially you get the 3 W's. You get to know what to buy, you get to know when to buy it, and why to buy it, which is crucial. And if you think that's something that's going to add value to your portfolio and to your portfolio growth, if you want to get involved in that whole thing, we're going to be meeting each other eventually. We're doing an in-person meetup, hopefully end of this year or next year. Not sure yet, but we're working on it. So we're probably going to do something in London maybe, or Milton Keynes or something like that. But if you want to get involved in this, we're going to be doing merch as well, t-shirts and stuff like that, which is cool. Click on the link in the description. That will take you to sussexinvestmentclub.com. Read about what we're doing. If you're interested, you can enroll from the website. If you're not interested, totally cool. If you know you're not interested right now, again, don't even bother going to the website. Just go to your next video. But thank you very much for watching. I hope it's been useful. Hope it's added value. And I'm really glad to be back. This is going to be awesome. So I'll hopefully see you in episode number 52. Cheers, guys.